Guys, I want to begin with what changed this week for all three of you. Did anything change for you this week, Oksana, given all the data we had throughout the week so far?
Nothing's really changed on the economic backdrop. I mean, we did have a weak ISM number there, but then we had sort of an on-track jobs number and a revision, an upward revision for August. And we've been in this trend for a while now where the revisions have been up. So it's kind of a weird, environment that we've been in where the unemployment picture continues to be strong. And in terms of the Fed, the probability of a Fed cut actually went down slightly, I think from around 90% to about 75 or so. But again, the Fed is continuing to walk a really tight rope here. The economy is continuing to, you could call it slow down, or you could call it kind of continue to grow at a slower pace.
Yep.
Does it warrant a return back to extraordinarily accommodative measures? We think not, but the Fed is caught in a tough spot here.
What's your take, Lisa?
I tend to agree with everything Oksana said. I mean, our view has been for a while that the U.S. is going to slow from the previous pace that we saw. Last year was clearly tax-induced growth. We've come down to closer to 2% this year. Our view for the rest of the year is 1.5 to 2, give or take. So this is exactly what we're thinking. Manufacturing is clearly in a recession. That's a global phenomenon. It's not aided particularly by what's going on in trade in the U.S., but everything else seems to be fairly stable. Yes, we had the weak service number. We have to see if that continues. But for us, this is more of a 1.5%, 2% U.S. economy.
That was the story coming into 2019, Gershon. Many people forecast that we would return to trend growth. We are arguably doing that right now. Many people also said payrolls growth would decelerate. We've arguably seen that over the last 12 months as well. Yet when you get punched in the face by a growth scare, you get gripped by end-of-cycle dynamics, end-of-cycle anxiety. What's your message for people that are going through that right now?
Well, I think it gets back to what did we learn this week? So we learned that manufacturing is a lot weaker than we all thought. Maybe it's not a matter of, we can have a trade war, not have a trade war. Maybe all the uncertainty, because we don't know what tomorrow is going to bring under the Trump presidency, businesses, CEOs, they're not confident to spend money. The million-dollar question, or the billion-dollar question, is really, does it spread? Does it start to spread to the consumer? Payrolls today aren't going to tell you anything because that's going to be a lagging indicator. The other thing I think that we did learn this week, and maybe this is where I might disagree a little bit, is despite what the market's saying, I think this ensures the Fed's going to cut in October. If you listen to what Chairman Powell said last time, he said he felt like they were good for right now. There was no reason based on what they knew to cut further, but they were going to react and consider the incoming data. I think this is a very clear sign that they're going to continue to cut.
There's a little bit of tension out there at the moment, though, Gershon. The data certainly says maybe now you should be cutting again. But listening to the officials through much of this week, and we close out the week with Chair Powell, but through much of the week, the officials not really showing their hand here. Not really showing their hand here at all. What gives you the conviction that in October, at the end of this month, they make another move?
Because it's what they said. Remember, they didn't say that it's not clear if we actually go into a recession. I hate using the word recession because I don't even know what that means anymore. But if we have a protracted slowdown, let's say, it's not clear how much leg room they have using conventional policies. Maybe they go to QE again. But what they have said is they think that being preemptive can avoid a slowdown. And if they're starting to see weaker numbers, even if it's in only a little part, they're going to say, well, we don't know if it's spreading to the consumer. We might not have that data anytime soon. As an insurance policy, we're going to continue to ease.
Oksana?
Well, of course, the problem with being preemptive is that we've seen it not work across the pond in Europe and in Japan. And that's really the issue. The big issue is the Fed really frittering its ammunition away for a time when it may need it and it won't have it. In terms of consumer confidence, that's a really important piece, and that's a piece we're watching very closely because, of course, the U.S. consumer has been sent out endlessly. It's 70% of the U.S. economy. And now what we're seeing is, the University of Michigan Consumer Sentiment Index is starting to move down, CEO confidence is starting to move down, business confidence is starting to move down, in spite of some of the economic positive surprises, frankly, that we've seen. So if you look at some of the economic surprise indices, they've actually trended up, but consumer and business confidence is trending down. So this is a really kind of tough rope again for the Fed.
Although we have a little bit of a disconnect, right, between the survey data, the confidence data, and actually the hard data. So when you look at the hard data, retail sales, for example, last month was extraordinarily strong.
And that's consistent with strong employment, right? So when employment continues to be strong, we're going to continue to see strong retail numbers. But certainly consumer confidence is really important. And we've seen it also hit across the pond where, the savings rate is starting to move up to pre-crisis level in Europe, in spite of the fact that rates are negative and consumers are not really gaining anything from putting their money into.
To be clear, I don't think the Fed necessarily should cut. I'm just listening to what they've been saying.
Yeah.
I agree. There's definitely a danger that you get into the point where, where Europe is, where Japan's been forever, where you either have to go unconventional or you have to or it will be too late.
We need to have the will-won't conversation, not the should-shouldn't. And let's have the will-won't conversation. The bond market quite clearly picking up on the idea that they're taking another step towards a rate cut. The bull steepener through this week, Gershon, just a massive outperformance we saw at the front end of the Treasury curve. What did you think about that? Because if I thought we were going to get some really bad data this week, I would have thought duration would have done pretty well this week. I would have thought we'd see a bond market move as well. I did not think that Treasury yields would do what they've done and bond yields would do nothing through the week, pretty much unchanged over the last 5 sessions. What do you make of all of that?
Well, it gets to the discussion we've been having for a long time. Is it justifiable that bond yields are so low? Do you really think that you're either going to go into deflationary spiral or you're going to have negative real rates and no inflation for the decade? I thought the more interesting thing in the U.S., though, was the implied break-evens and tips, which hit a 10-year low of, I think, 147 earlier in the week. So basically, essentially, rounding error, you're sort of zero inflation, a zero real rate baked in for the next 10 years. That's a very pessimistic sign. And I continue to think that one of the markets is wrong. Either the Treasury market's wrong or the equity markets are wrong. If we're really going to not get any real rate of return, we're not going to get growth, we're not going to get inflation, equities are way too high. If things are going to be fine, yield should be a lot higher.
If you had to take some optionality on one of the outcomes right now, if you had to have a base case, what would it be?
I don't know if I should say this, but I think our base view is that we're gonna have a slowdown here. I don't want to use the word recession again, because I don't even know what it means. It's going to be a protracted slowdown. The Fed's probably going to eventually have to react. And I don't know, is that really a bad thing? We're 11 years into an expansion. I get it that, like, in theory, right, central banks, monetary policy is supposed to keep the economy as level as possible, but that's really only in theory. We haven't repealed the laws of economics. There are shocks all the time. And, I probably shouldn't say this, but maybe a little mini type recession, slowdown, whatever, clears out some of the excesses, some of the businesses that have been formed that shouldn't exist, and sets us up for a better path for the next decade. I wouldn't rule that out.
You used the word. You're just calling it a mini recession now, whatever that is.
The R word is a very dirty word at our firm. We don't like to use it, and we don't even know what it actually means. It's like we pretend like there's this line, how we define it, 2 negative quarters of negative GDP, doesn't even apply internationally because China's still growing. You're not going to get that on a global growth. But it's like, all right, if we are a little bit to the left of this line, it's a big problem. A little bit to the right, we're fine. That's not how it works. It's a continuum, and that's what we're seeing right now.
Couldn't agree more. The fact that you can go into a shallow slowdown or a mini recession has become anathema, and markets kind of cannot get rid of this binky, and they keep going back to the Fed and other central banks like, rescue us, make this go away. And the reality is that you have to go through a business cycle. That's the healthy thing to do. And on rates, you're absolutely right, Jonathan. We're seeing perhaps the limits of central bank policy, because not only have U.S. rates not really, or the bonds have not really responded dramatically. If you think back to when the ECB threw everything in the kitchen sink a few weeks ago at the market, it opened up the purchase program to $20 billion, lowered the deposit rate. Bond rates are actually higher today than they were at that point in time. So perhaps we're seeing kind of the limits of central bank policy, and that's important for portfolios, right? Because let's bring it back to what's happening in portfolios. Portfolios are chock full of duration that is entirely interest rate risk and moves entirely on what happens to the 10-year here. And I think the return potential here is extremely limited.
Final word, Lisa.
I think that there's a floor on bond yield. That's what I was going to say right before you jumped in, is that the ECB basically said they're done with monetary policy. There's nothing more that they can do, which kind of puts a floor to where they can go. Yes, they hit negative 80 basis points, but negative 60 is still an unreasonable level, in my opinion. I think we're kind of reaching the end, and now you're starting to hear talk about more fiscal stimulus. Even in Germany this week, there was talk about dropping the black zero, the ability to have any sort of budget deficit spending, I think we'll hear more about that in the coming weeks and months, because we need to move into a world of fiscal. I think that's what people are coming around to, and I think
a lot of people agree with you too.
I think that's negative for bond yields.